Usually when a massive trillion-dollar tech giant announces that it is going to just completely rebuild its core engine, Wall Street really braces for impact.
Right. I mean, you expect some serious turbulence.
Exactly. It is a bit like watching a property manager try to, fundamentally renovate a massive skyscraper while all the commercial tenants are still inside. Like, they're just trying to go about their daily operations.
Yeah, you expect dust, you expect noise.
And you definitely expect the rent revenue to drop for a while, right?
Yeah.
As the disruption takes its toll, you brace for margin compression.
Oh, 100%. You expect the bottom line to take a visible hit while they pay for all that metaphorical scaffolding. I mean, in the hardware-heavy world of tech infrastructure, it's treated almost as a law of corporate physics.
Right.
When capital expenditures go up that aggressively, operating margins must come down.
But then you step into the world of hyperscalers and you look at Alphabet's Q1 2026 earnings report, and suddenly that skyscraper isn't just fully renovated, it's somehow twice as tall. The tenants are paying significantly more, and the construction costs, while absolutely enormous, they didn't even dent the landlord's profitability.
It's honestly wild to see on paper.
It really is. So welcome, everyone. If you are a professional investor, a portfolio manager, or really just someone trying to cut through the absolute noise of the market right now, you are in the right place. Today, our deep dive mission is unpacking Alphabet Inc.'s jaw-dropping Q1 2026 earnings report.
And we've got a lot to get through.
We do. We've got a really substantial stack of sources on the table today. We are looking directly at the official Alphabet SEC filings and their Q1 press release, and we are cross-referencing those primary documents with financial analysis from AFC Antalicus, Search Engine Journal, Investing Live, thedesk.net, and FX Street.
So we're really getting a full 360-degree view here.
Exactly. Our goal here isn't just to, read you the top-line numbers. You already saw those flash on your terminal.
You don't need us for that.
No. Our mission is to provide you with a comprehensive financial breakdown of these blowout results. We're going to highlight exactly how the revenue segments are shifting beneath the surface, the mechanics of how they are reducing AI compute costs.
Which is huge, by the way.
Oh, massive. And we'll look at the strategic logic behind their debt issuance and why Wall Street reacted by sending the stock surging 6% in after-hours trading. Okay, let's unpack this.
Let's do it.
We have to start with just the sheer scale of the revenue beat. So Alphabet reported total Q1 revenue of $109.9 billion.
Wow.
Yeah, that completely crushed the consensus estimate, which was sitting at around $107.1 billion. So it's up 22% year over year, or 19% if we're adjusting for constant currency.
Which for a company that size is it's phenomenal growth.
It is, but I mean, top line beats happen, right? The number that made me actually stop and reread the filing was the operating income.
Oh, yeah. That was the jaw dropper.
It surged 30% to $39.7 billion. And they actually expanded their operating margin by 2 full percentage points to 36.1%.
And, see, that margin expansion fundamentally breaks the prevailing market narrative right now.
How so?
Well, for over a year now, the dominant fear among institutional investors was that Alphabet's massive AI infrastructure build-out would act as a severe drag on profitability.
Right. Because GPUs are not cheap.
Exactly. The consensus was that buying hundreds of thousands of GPUs and outfitting these next-generation data centers, it was just too capital-intensive to sustain their historic margins.
Yeah.
But instead, we are seeing incredible operational discipline. I mean, they are expanding their profit margins while simultaneously executing one of the largest corporate capital expenditure programs in history.
Yeah, so let's put a hard number on that capex because it's staggering. They spent $35.67 billion on capital expenditures in the first quarter alone.
In 90 days.
In 90 days. Now, that was slightly below the $36.39 billion whisper number that analysts were expecting, but it solidly confirms they're sticking to their massive $175 to $185 billion full-year target.
Right.
But spending nearly $36 billion while expanding margins to 36.1% is just, it's wild. But as an investor, I have to look under the hood and ask, where's the leverage actually coming from?
Absolutely.
Because the headline net income skyrocketed 81% to $62.6 billion, right? With diluted earnings per share jumping 82% to $5.11. So I have to ask, is that 81% jump purely from their core operations, or are we looking at some heavy financial engineering here?
So you really have to strip out the noise there, because that 81% net income figure is heavily distorted by accounting rules.
Okay, I figure as much.
Yeah, it includes a massive windfall in their equity investments, which we'll dissect later when we get to the balance sheet discussion.
Got it.
But if you're building a model to project their future free cash flow, you have to separate that out. The true health of the fundamental business engine is represented by that 30% surge in operating income.
That $39.7 billion.
Exactly. That $39.7 billion is pure core operational strength. It proves that the underlying business model is highly leverageable, meaning their revenue is scaling significantly faster than the fixed costs associated with delivering that revenue.
Okay, so that brings us to the next logical question. We just talked about the massive cost of building this AI infrastructure, right? That almost $36 billion capex bill.
Right.
The only way a company can stomach that kind of outlay in a single quarter is if that investment is generating explosive returns somewhere else in the stack.
Precisely.
So we have to look at the segment breakdown. And the undeniable catalyst of this earnings beat, it really lives in Google Cloud.
Oh, absolutely. The figures here are just staggering.
Yeah, Google Cloud revenue surged 63% to $20.03 billion. That totally obliterated the $18.41 billion estimate.
And remember the context here. I mean, in Q4 of 2025, cloud was growing at 48%.
So we aren't just seeing growth. We are seeing violent acceleration at scale.
Yes, and operating income for cloud hit $6.59 billion.
Wow.
What's fascinating here is that this 63% acceleration is the most direct empirical evidence we have seen that AI infrastructure is actually converting into recognized enterprise revenue.
Right, because that was the big worry, wasn't it?
Exactly. For the last several quarters, the market has been highly skeptical of the return on investment for generative AI. Analysts just kept asking how these models would be monetized beyond, basic consumer subscriptions or ad enhancements.
Like, where's the real enterprise money?
Right. And Google Cloud is providing the answer. Enterprise clients are actively migrating complex, compute-intensive AI workloads onto the Google Cloud platform, and they are paying a premium for it.
Well, and Sundar Pichai dropped a metric on the earnings call that really underscored that enterprise demand. He noted that the cloud backlog nearly doubled quarter on quarter to over $460 billion.
Yeah, that number is huge.
But see, I'm kind of stuck on this $460 billion backlog number. It's massive. It's roughly 4 times their annual cloud revenue. So as an investor, my immediate fear is the classic enterprise software boom and bust cycle.
Oh, I see where you're going.
Yeah, like our CIOs just hoarding compute capacity, signing these massive multi-year commits because they're terrified of being left behind by competitors? Or is this actual sticky integration?
It's a fair question. The panic buying thesis is a very real risk in early technology cycles, right? Where enterprises over-provision out of FOMO, and then they have to optimize their spend downward a year later.
Right, we've seen that happen before.
We have. However, the utilization metrics in this report, they point to deep structural integration rather than just surface-level hoarding.
Okay, what metrics specifically?
Look at the API volume. Alphabet reported that their first-party models, specifically the Gemini family, they're now processing over 16 billion tokens per minute.
Wait, per minute?
Yes, per minute, via direct API calls from customers. And that volume is up 60% sequentially from the fourth quarter.
That's insane.
Right. You don't process 16 billion tokens a minute because you are afraid of missing out. You generate that volume because your developers have fundamentally wired these AI models into the daily operational architecture of your business applications.
That makes the revenue feel much more durable.
Exactly.
And if we are talking about durability, we have to look at the massive strategic move they made in March. Alphabet closed a $32 billion acquisition of the cloud security firm Wiz,
Right.
which they have now fully integrated into Google Cloud. It's the largest acquisition in the company's history. And to me, it feels like the ultimate play for enterprise stickiness.
Oh, without a doubt. The Wiz acquisition changes the entire enterprise cloud security architecture for Google.
Right.
And really, it's the anchor that prevents that $460 billion backlog from just evaporating.
How so?
Well, enterprise clients face a massive dilemma right now. They want to deploy generative AI across their proprietary data sets, but doing so creates unprecedented security vulnerabilities.
Because you're feeding your crown jewels into a model.
Exactly. If you are feeding your most sensitive corporate data into a foundational model, you need a zero-trust environment.
Right.
So by acquiring Wiz and bundling top-tier cloud security posture management directly with their top-tier AI compute, Google Cloud is eliminating the friction of multi-vendor security setups.
Oh, I see.
Yeah, once a Fortune 500 company integrates their proprietary data into GCP, secures the entire environment natively with Wiz, and then builds APIs calling Gemini millions of times a day, the switching costs become astronomically high.
You're locked in.
Completely locked in.
But, you can only build that kind of enterprise cloud backlog if your consumer-facing cash cow is throwing off enough cash to buy the infrastructure in the first place, right? That's the truth. So let's look at the front end of the business, Google Search. Because for the last 2 years, this was the segment that kept portfolio managers awake at night.
The existential threat.
Exactly. The fear was that generative AI chatbots would completely cannibalize the traditional 10 blue links, and more importantly, destroy the highly lucrative ads that live next to those links. I mean, if AI just gives you the answer, why click on an ad?
Right. And the narrative was that AI overviews would permanently compress search margins because generating a synthesized AI response requires significantly more server compute power than simply querying an index and retrieving a list of web URLs.
Yeah, it's just a heavier lift. But yet, the Q1 numbers show a core business that is just entirely unfazed. Google Services' total revenue reached $89.6 billion. That's up 16%.
Incredible.
And within that, Google Search and Other grew 19% to $60.4 billion. And Pichai explicitly noted that search queries are at an all-time high.
Wow.
Yeah, he pointed directly to features like AI overviews and AI mode, which now apparently boasts around 100 million monthly active users, as the primary drivers of this engagement.
So people aren't leaving search for chatbots.
No, they are coming back to search more frequently because the product is actually better.
But the critical piece of the puzzle isn't just user engagement, right? It's the underlying unit economics of serving those queries.
Right, the cost.
Exactly. The existential threat wasn't just revenue cannibalization, it was a cost explosion. How do you offer computationally expensive AI answers without just destroying your margins?
Well, the sources highlight 2 massive efficiency breakthroughs on that front. First, they reported that search latency is down 35% over the last 5 years, even with complex AI models layered into the results.
That's a huge technical achievement.
It is. But second, and this is the metric that secures the operating margin, Pichai stated that the cost of serving core AI responses has dropped over 30% since they upgraded to the Gemini 3 architecture.
A 30% reduction in compute costs at this scale is, it's staggering.
How are they pulling that off?
It points to a combination of custom hardware efficiency, likely massive advancements in their tensor processing units, their TPUs, and also algorithmic breakthroughs like model quantization, where they are running smaller, highly specialized models to rote queries rather than firing up a massive monolithic model for every single user search.
Oh, that makes sense. You don't need the Genius model to tell you what time it is in London.
Exactly. And that means the margin penalty for offering AI answers is shrinking rapidly.
Here's where it gets really interesting to me. I think about AI overviews, like offering a high-end, expensive appetizer for free at a restaurant, right?
I like that analogy.
A year ago, analysts were terrified that if you give the customer this amazing free appetizer, they wouldn't order the main course, which in this case is clicking on search ads.
Right. They'd just eat the appetizer and leave.
Exactly. But the data suggests that the appetizer is just making the restaurant so popular that foot traffic is through the roof.
Oh, interesting.
By satisfying certain search intents faster and more comprehensively with AI, they are increasing overall user trust and frequency of use. If a user queries Google 20 times a day instead of 10 because the AI results are so good, the total surface area for ad monetization expands.
Right, even if some of those specific AI-answered queries don't feature a single ad.
Exactly. But I've got to play devil's advocate here and look for cracks in the ad model as a whole.
Let's do it.
Because if search is booming at 19% growth, why are we seeing distinct weakness in other advertising segments? Like YouTube ads grew 11% to $9.88 billion, which actually slightly missed the $9.97 billion consensus estimate.
Which is a slight miss, but still.
True, but more concerningly, the Google network, which places ads on third-party websites across the internet, it actually shrank. It fell 4% to $6.97 billion. Are there cracks in the traditional third-party ad model?
Yes. What we are seeing is a stark bifurcation between owned and operated properties and third-party networks.
Okay, unpack that.
So Google's search environment and YouTube, those are highly controlled ecosystems, right? They dictate the user experience, they own the first-party data, and they completely control the ad placement.
Walled gardens.
Exactly.
Yeah.
But the Google network relies on the broader ecosystem of independent publishers. And that space is under immense macroeconomic and regulatory pressure.
Like the privacy changes.
Precisely. Cookie deprecation, enhanced privacy protocols from Apple and others, and changing browser standards. They are severely degrading the targeting efficiency of third-party networks.
It's the classic flight to quality. Advertisers are just pulling money out of the open web and consolidating it into walled gardens where the attribution is clearer.
Exactly.
And regarding the slight YouTube miss, I mean, while 11% growth on nearly $10 billion is still a massive absolute number, it does show some moderation in video ad spend. But the slack there seems to be picked up by a much higher quality revenue stream subscriptions.
Oh, absolutely.
Yeah, the subscriptions, platforms, and devices segment hit $12.4 billion. That's growing a very healthy 19%. And they noted that total paid subscriptions across YouTube Premium, YouTube TV, and Google One have now reached 350 million.
And that's huge, because converting heavy ad-supported users into recurring subscription revenue is a tremendous evolution for their business model.
Because it's guaranteed money.
Yes, subscription revenue is stickier, it's more predictable, and frankly, it commands a higher multiple from the market because it isn't subject to the month-to-month volatility of corporate ad budgets.
So all of this operational momentum, the cloud acceleration, the search resilience, the subscription pivot, it ultimately flows down to the balance sheet.
Right.
And this is where we see the maturation of Alphabet as a massive financial institution, not just a tech company.
It's a whole different level.
It is. So how are they managing this resulting mountain of cash, and what does it actually mean for your portfolio? Let's look at capital return first. Alphabet announced a 5% increase to its quarterly cash dividend, bringing it to $D.22 per share, payable in mid-June 2026.
So if we connect this to the bigger picture, a dividend increase from a hyperscaler midway through an aggressive infrastructure cycle is a massive signaling mechanism.
It's a flex.
It is a total flex. They are communicating to institutional investors that their free cash flow generation is so incredibly robust that they can afford to spend $35 billion a quarter on capex.
Right.
Acquire a $32 billion security firm in cash, and still steadily increase the yield they hand back to shareholders. It is a statement of supreme financial confidence.
Now, earlier we flagged the headline net income jump of 81% to $62.6 billion, and you warned that we needed to separate the core operations from financial windfalls.
Yes, we need to circle back to that.
Let's do it. Because the SEC filings show a staggering net gain of $37.7 billion recorded under other income and expense. And that's primarily derived from unrealized gains on non-marketable equity securities.
Right. So Alphabet essentially operates a massive embedded venture capital arm alongside its core business.
GV and capital G, right.
Exactly. And when the valuations of the private, early-stage companies they hold equity in are marked up in new funding rounds, accounting rules require Alphabet to recognize those gains on their income statement, even if they haven't sold a single share.
So it is entirely paper wealth at this stage.
Yes, exactly. It is a massive $37.7 billion windfall that contributed heavily to that headline $5.11 earnings per share number.
Okay.
But it is unrealized.
Okay.
If a portfolio manager is trying to value the core search and cloud business, they have to strip that $37.7 billion out and focus on the $39.7 billion in operating income we discussed earlier.
Because they're two different beasts.
Right. Both are technically good news, but one reflects the structural leverage of the company, and the other reflects the mark-to-market mechanics of private equity.
That makes perfect sense. So let's look at the actual liquidity then, because here is the financial paradox I am struggling with, and I bet a lot of folks looking at the raw filings are scratching their heads over it too.
What's that?
Alphabet has total cash, cash equivalents, and marketable securities standing at a truly massive $126.8 billion.
Swimming in it.
Swimming in it. They just posted nearly $40 billion in operating income in a single quarter. They are drowning in liquidity. So why on earth do the SEC filings show that in Q1 2026, they issued senior unsecured notes for net proceeds of $31.1 billion?
Oh, the debt issuance.
Yeah, I mean, if you have $126 billion sitting in the bank, why are you issuing $31 billion in new debt?
This gets into the really advanced mechanics of corporate treasury management. You have to consider the cost of capital, the geographic location of their cash, and the immediate liquidity demands of strategic acquisitions.
Okay, break that down for me.
First, a company with Alphabet's pristine credit rating can issue senior unsecured notes at incredibly attractive interest rates, even in a normalized rate environment.
Right.
So if they can borrow money at, say, 4.5%, but their internal cash reserves are generating a 5.5% or 6% return parked in various marketable securities. It makes mathematical sense to utilize debt.
It's just the classic arbitrage of cheap corporate debt.
Exactly. But the second, and arguably more important factor, involves repatriation tax traps.
Ah, right. The offshore cash.
Yes. A significant portion of that $126 billion cash pile is likely held offshore in overseas subsidiaries. Repatriating tens of billions of dollars back to the U.S. to fund domestic operations or acquisitions could trigger significant corporate tax liabilities.
Nobody wants to pay those taxes if they don't have to.
Never. And third, we have to factor in the immediate mechanics of that $32 billion Wiz acquisition.
Right, because that was an all-cash deal.
Exactly. When you close a cash deal of that magnitude, you need immediate liquid capital in the correct jurisdiction. So issuing $31.1 billion in senior notes is a highly efficient way to fund that massive acquisition without having to prematurely liquidate high-yielding assets or take a massive tax hit on repatriating offshore cash.
So it's just textbook balance sheet optimization.
100%.
They aren't borrowing because they lack capital. They are borrowing because it is the mathematically optimal way to maneuver capital around a complex global tax structure to pay for a giant asset.
It is the financial machinery of a trillion-dollar entity operating at the absolute highest level of efficiency.
All right, let's pull all of this together. We have covered a lot of ground today.
We really have.
If you are updating your valuation models or, preparing your briefing for your next investment committee meeting, here are the primary takeaways from this deep dive into Alphabet's Q1 2026.
Number one.
First, we saw an undeniable 63% acceleration in Google Cloud, backed by a $460 billion backlog and the strategic integration of Wiz. This provides hard empirical proof that the AI infrastructure cycle is translating into recognized, sticky enterprise revenue.
Huge point.
Second, the traditional search engine is not dead. It is highly resilient, growing 19%, with margins protected by a staggering 30% drop in AI compute costs for Gemini 3.
Also huge.
And third, management is demonstrating supreme confidence through a 5% dividend bump, effectively balancing historic capex spending with shareholder returns while using sophisticated treasury tactics to fund massive acquisitions.
And honestly, understanding the nuance between their core operating leverage and those unrealized equity windfalls we talked about, that is what gives you a strategic edge over the headline readers. The market was looking for margin compression, and instead they got a masterclass in hyperscaler economics.
Absolutely. But before we wrap up, there was one tiny detail buried deep in the prepared remarks of the sources that I wanted to highlight.
Oh, yeah.
A forward-looking seed that I think everyone needs to keep on their radar.
Yes. This is something I want you, the listener, to really mull over. Sundar Pichai casually mentioned, almost as an aside, that Waymo just surpassed 500,000 fully autonomous rides a week.
500,000 rides a week, moving actual people through actual cities without a human driver.
Right. And right now, every eye on Wall Street is entirely focused on generative AI and the cloud segment in this report.
For good reason, obviously.
Sure. But Waymo represents physical AI. It is autonomous transport operating safely at scale in the real world. And currently, it is still buried in their other bets segment, basically operating at a loss.
For now.
For now. But consider the trajectory. What happens to Alphabet's overall valuation when physical AI like Waymo hits the exact same parabolic revenue inflection point that we just witnessed with Google Cloud this quarter?
Wow.
Generative AI is transforming enterprise software and knowledge work, but physical AI is going to transform the logistics of the real world. That is the next massive horizon.
That is a staggering thought. It really brings us right back to our opening metaphor. Wall Street is so busy marveling at how Alphabet renovated the skyscraper without losing any of the commercial tenants, they might not have noticed that the landlord is also quietly building a massive fleet of autonomous vehicles out front to drive everyone to work.
Yep. It's not just a renovated building. They're laying the infrastructure for an entirely new city block.
And that is where we will leave it for today. Thank you for joining us on this deep dive into the numbers behind the headlines. Keep questioning the consensus, and we will see you next time.